Hey, welcome back. If you are retired, if you are getting close to retirement, or if someone in your family depends on Social Security, then you need to stop whatever you are doing right now and pay close attention to what I am about to tell you because something big is happening. And it is happening fast. We are talking about a major shakeup to the Social Security system that is landing right here in early March 2026. And the honest truth is that millions of Americans have absolutely no idea this is coming. And when you don't know about changes like this, it can cost you money. It can cause you serious stress. And it can leave you scrambling when you least expect it. So today, we are going to break all of this down in plain, simple, everyday English. No complicated government language, no confusing financial jargon, just clear, easy to understand information so that you can walk away today knowing exactly what is going on and what you need to do about it. Let's get into it. So, first, let's talk about the big picture. 2026 has already been a big year for Social Security, and we are not even 3 months in. There have been more changes to this program in the last few months than most people realize. And when we say changes, we don't just mean small tweaks. We are talking about changes to how much money you receive every single month. Changes to how the government handles your appointments and customer service. Changes to how much you can earn if you're still working while collecting benefits. Changes to how your benefits are taxed. And even changes to how certain groups of Americans like teachers, firefighters, and other public servants finally get the money they were owed for years. Every single one of these changes can affect your life in a real, measurable way. So we are going to go through each one of them step by step. And by the end of this video, you are going to feel way more confident and way more prepared. Let's start with the change that most people are excited about. The cost of living adjustment, which most people simply call the COLA. Now, the Social Security Administration does this every year. They look at how much prices have gone up across the country, things like groceries, gas, rent, medicine, and then they adjust your Social Security check to try to help you keep up with those rising prices. For 2026, that adjustment is 2.8%. Now, I know that might not sound like a huge number, but let's put it in real dollars, so it actually makes sense. The average retired worker in America was receiving about $2.15 per month in Social Security benefits in 2025. With the 2.8% COLA, that average check has now gone up to about $2,071 per month. That is an increase of roughly $56 a month. If you look at that over a full year, that's an extra $672 in your pocket compared to last year. For married couples who are both receiving Social Security, the increase is even more noticeable. Their combined monthly benefit has gone up by about $88, bringing their average combined check to around $328 per month. Now, that sounds great, and honestly, it is better than nothing. But there is a catch, and we need to talk about it honestly because I don't want to paint a rosy picture that isn't completely accurate. The catch is Medicare. If you are 65 or older and you are on Medicare, the government automatically deducts your Medicare Part B premium from your Social Security check every single month. And here's the problem. Medicare Part B premiums also went up in 2026. They jumped by about $17.90 per month, going from $185 per month up to about $21.90 per month. So when you do the math, your Social Security check went up by $56, but your Medicare costs went up by about $18. That means the real, actual take-home increase for the average Medicare enroll is closer to about $38 per month. That's still money in your pocket, and every dollar counts when you're on a fixed income. But you need to understand what is actually happening so you don't get confused when you look at your bank statement and wonder why the increase seems smaller than what you heard about. If you haven't already reviewed your net benefit amount since January, right now is a great time to do that. Just log into your My Social Security account at ssa.gov and take a look at what you're actually bringing home each month. Now, let's talk about something that is causing a lot of people real concern right now, and that is the major administrative change coming to the Social Security Administration starting on March 7th, 2026. This is where things get a little complicated, and it's something a lot of people are just starting to hear about. Here's what's happening. For decades, when you needed help from Social Security, whether you had a question about your benefits, needed to report a change, wanted to start receiving benefits, or had a problem with your account, you could call or visit your local Social Security office. Each office served the people in its surrounding area, and the staff there were familiar with the local community and could schedule appointments for you directly. That system is now changing. Starting March 7th, the Social Security Administration is shifting from local office scheduling to a centralized nationwide customer service system. What that means in plain English is that your local office is no longer going to be handling appointments directly. Instead, all of that scheduling is being moved to a national system. The stated reason for this change is to improve staffing efficiency across the country. But many experts and advocates for older Americans are warning that the real-world effect for many retirees could be longer wait times, harder to schedule appointments, and more frustration when trying to get help with something important. Think about it this way. Right now, if you need to talk to someone at your local Social Security office, you can call them. Maybe wait on hold for a bit, but eventually get through to someone who knows your area and can book you an appointment. After March 7th, that process changes. You'll be routed through a national system, which means you could be waiting much longer to get through, and the person you talk to may not have the same local knowledge or availability. For people who are dealing with time-sensitive issues, like a problem with their benefits, an identity issue, or trying to get enrolled in benefits for the first time, this could be a real headache. So here is the important takeaway. If you know you have a reason to go to your local Social Security office, or if there is anything you've been putting off dealing with, please try to take care of it before March 7th. File online through ssa.gov wherever possible. If you need an in-person appointment, schedule it now before the switchover happens. Don't wait until after March 7 and then be surprised when things are harder to navigate. Getting ahead of this could save you a lot of time, stress, and frustration. Now let's talk about something really important for people who are collecting Social Security but are still working. This is something that a lot of people don't fully understand, and it catches people off guard all the time. There is a rule in the Social Security system called the earnings test, and here's how it works. If you have started collecting Social Security benefits, but you have not yet reached what the government calls your full retirement age, and you are still earning money from a job, there is a limit to how much you can earn before Social Security starts temporarily holding back some of your benefits. Now, your full retirement age, which we call FRA, depends on when you were born. If you were born in 1960 or later, your full retirement age is 67. If you were born before 1960, it's slightly lower. For example, if you were born in 1959, your full retirement age is 66 years and 10 months. So, here's the good news for 2026. The earnings limit has gone up. For people who are below their full retirement age for the entire year, the earnings limit is now $24,280. That went up from $23,400 in 2025. If you earn more than that limit, Social Security will temporarily hold back $1 for every $2 you earn above that threshold. So, for example, if you earn $40,000 from work in 2026, your benefits for the year would be reduced by about $7,760, which is half of the difference between $40,000 and $24,480. Now, I want to stress the word temporarily here because this is where a lot of people get confused and panicked. The money that gets held back is not lost forever. Once you actually reach your full retirement age, the Social Security Administration will recalculate your monthly benefit and pay you back for the money that was withheld. Your monthly check actually goes up to account for the months that were reduced. So, it is not a penalty. It is more like a delay. but you still need to know about it so you are not caught off guard by a lower than expected check in the meantime. And for people who are going to hit their full retirement age sometime during 2026, there is a different higher earnings limit that applies for those months leading up to your birthday. That limit is $65,160. And for that group, the reduction is $1 for every $3 earned above the limit, rather than $1 for every $2. And of course, once you have officially reached your full retirement age, there is no earnings limit at all. You can earn as much as you want from work without any impact on your Social Security benefits whatsoever. Now, let's talk about something really exciting that happened earlier this year, something that many public employees have been waiting on for a very, very long time. For years and years, there were two rules buried inside the Social Security system called the Windfall Elimination Provision and the Government Pension Offset. These two rules significantly reduced or even completely eliminated Social Security benefits for millions of Americans who worked in jobs that didn't pay into Social Security. Jobs like teaching in certain states, police and fire departments, and other government positions. These workers spent their careers in public service, often at lower pay than private sector jobs, and on top of that, they were getting hit with these reductions to their Social Security. It was a situation that felt deeply unfair to a lot of people, and advocates had been fighting to change it for decades. Well, early in 2025, Congress finally passed the Social Security Fairness Act, and it was signed into law. This legislation eliminated both of those rules, the Windfall Elimination Provision and the Government Pension Offset, effective immediately. For many affected workers, this meant a real, meaningful increase in their monthly Social Security checks. And not only that, but many of these individuals also received retroactive lump sum payments to make up for the money they were shortchanged in prior months. Now, here's where there's an important tax wrinkle that a lot of people didn't see coming. Those retroactive lump sum payments, which could be several thousand for some people, may be taxable income. That means for people who received those payments, they could see a smaller tax refund this year or even owe money when they file their 2025 tax return. There's actually a bill in Congress right now called the No Tax on Restored Benefits Act that would exempt those retroactive payments from federal taxes. But as of today, that bill has not been passed into law. So if you are a teacher, firefighter, police officer, or other public employee who received one of those lump sum payments, please talk to a tax professional before you file your return. This is something you absolutely do not want to get caught off guard by. The good news is that going forward, your regular monthly benefit going forward is simply higher, and you get to keep the full benefit of the Social Security Fairness Act without the same tax complication. Let's talk for a moment about the big picture financial health of Social Security, because this is something that every single person who relies on these benefits or plans to rely on them someday needs to understand. The Social Security Trust Fund, which is basically the reserve pot of money that helps fund the program, is under increasing financial pressure. Experts have been warning for years that if nothing changes, the trust fund could be depleted sometime in the early 2030s. Some estimates now say as soon as 2032 or 2033. If that were to happen, Social Security would not just disappear, but benefits could automatically be cut by somewhere around 20 to 23% across the board. That would be an enormous blow to tens of millions of Americans who depend on this money to pay their rent, buy their groceries, and cover their medical bills. Now, there are several reasons this pressure is building up. Baby boomers, the huge generation born between 1946 and 1964, are retiring in large numbers, which means more people drawing benefits. At the same time, birth rates have slowed down, meaning there are fewer younger workers paying into the system relative to the number of retirees collecting from it. And on top of that, some of the recent changes, including the Social Security Fairness Act and certain budget decisions, add additional costs to the system without new revenue to offset them. Does this mean you should panic? No. Congress has fixed Social Security funding problems before, and it is very politically difficult for any elected official to allow benefits to be slashed. But you should absolutely pay attention to this, stay informed, and encourage your representatives to take action sooner rather than later. The longer Washington waits to address the funding gap, the harder and more painful the solutions will be. This is your retirement security we are talking about, and you have every right to know the full truth about it. Now let's switch gears and talk about something that could actually put more money in your pocket, especially if you are 65 or older. Thanks to the big tax and spending legislation that Congress passed in the summer of 2025, there is a brand new tax deduction available for older Americans in 2026. Here's how it works. If you are 65 or older at the end of 2025, you may be able to deduct up to $6,000 from your taxable income. This is in addition to the regular standard deduction that everyone gets. Now, there are income limits. If you are a single filer and your adjusted gross income is under $75,000, you can claim the full $6,000 deduction. If you are married and filing jointly, the income limit is $150,000 combined. If your income is above those limits, the deduction phases out, meaning you get a smaller deduction the higher your income goes. For people who are in that eligible range, this new deduction can reduce, or in some cases completely wipe out, the federal income taxes on your Social Security benefits. That is real money. Talk to your tax preparer about this one, because a lot of people are going to miss it simply because they don't know it exists. Here's another thing to be aware of for 2026. The wage cap for Social Security taxes has gone up. Now, this one matters more for higher earners, but it's worth understanding. When you work, you and your employer both pay a 6.2% Social Security tax on your wages, but that tax only applies up to a certain dollar amount of income each year. In 2025, that cap was $176,100. In 2026, that cap has risen to $184,500. So if you are earning more than that, anything above that ceiling is not taxed for Social Security purposes. This change doesn't affect most workers directly since it applies to higher earners, but it does affect the revenue coming into the Social Security system and has some connection to the program's long-term funding. For workers who earn in that higher range, it means slightly more of their income will be taxed for Social Security in 2026 than it was in 2025. Also, for anyone who is still building towards Social Security eligibility, meaning you haven't yet earned the 40 credits you need to qualify for retirement benefits, there is a small but important change to how those credits are calculated. In 2026, you need to earn $1,290 in wages or self-employment income to earn one Social Security credit. That went up from $1,810 in 2025. You can earn a maximum of 4 credits per year. So you hit your 4-credit maximum for the year once your earnings reach $7,560. This is important for younger workers, gig workers, or anyone who works part-time to keep track of. You need at least 10 years of earning 4 credits a year to qualify for retirement benefits at all. So knowing where that bar sits helps you make sure you're on track. Now, for anyone who is thinking about when to start claiming Social Security, let's talk about how the timing decision works. Because this is one of the most important financial decisions you will make in your retirement, and getting it right can literally mean tens of thousands of dollars over the course of your lifetime. The earliest you can start collecting Social Security retirement benefits is age 62. But here's the thing, if you start at 62, your monthly benefit is permanently reduced compared to what you would get if you waited until your full retirement age. The reduction can be as much as 25 to 30% depending on your birth year. So if your full benefit at age 67 would be $2,000 per month, starting at 62 might get you closer to $1,400 or $1,500 per month. And that reduction stays with you for the rest of your life. On the other hand, if you wait beyond your full retirement age, your benefit actually continues to grow. You earn what are called delayed retirement credits, 8% per year, for every year you hold off collecting past your full retirement age up until age 70. So if your full benefit at 67 is $2,000 per month, waiting until 70 could give you a monthly check closer to $2,480. And for someone who lives into their mid-80s or beyond, that extra money adds up to a massive difference. If you can afford to wait, and especially if you are in good health, delaying Social Security is often one of the smartest financial moves a person can make. So let's bring all of this together and talk about what you should actually do right now today based on everything we've covered. The very first thing is to log into your My Social Security account at ssa.gov. If you don't have one yet, create one. It's free and it only takes a few minutes. From there, you can check your benefit amount, make sure your earnings history is correct, look at your COLA increase, and see exactly what you're going to receive going forward. The second thing is to take care of any Social Security business you've been putting off and do it before March 7th. That is the date when the new centralized scheduling system kicks in, and things could get more complicated after that. If you have an appointment you need to make it now. If you have paperwork you need to submit it today. Third, if you are a public employee who received a retroactive lump sum payment from the Social Security Fairness Act, please talk to a tax professional before you file your taxes. The last thing you want is to be surprised by a big tax bill because you didn't know that money counted as taxable income. Fourth, if you are 65 or older and your income falls within the limits we talked about, make sure your tax preparer knows about the new $6,000 deduction available to you. This is money you deserve, and it's easy to miss if you're not paying attention. And fifth, if you are not yet collecting Social Security and are trying to decide when to start, take some time to really think through the timing. Or better yet, sit down with a Social Security advisor or financial planner who can run the numbers based on your specific situation and help you make the best decision for your individual life. Look, here's the bottom line. Social Security is not a perfect system, and it's going through a lot of changes right now. Some that help you and some that create new complications. But one thing has not changed. This program is the financial backbone for tens of millions of retired Americans, and staying informed about what is happening with it is one of the most important things you can do to protect your financial future. The changes we talked about today, the COLA increase, the Medicare premium offset, the March 7th customer service overhaul, the earnings limit update, the Social Security Fairness Act and its tax implications, the new senior deduction, and the long-term funding concern. All of these things affect real people with real bills to pay. You deserve to understand every single one of them. Knowledge is power, especially when it comes to your retirement. So share this video with someone you know who is on Social Security or getting close to retirement because they need to hear this too. And if you have questions, drop them in the comments below. We read every single one and we will do our best to help. Thanks for watching. Stay informed and we will see you in the next.